All right, so this is our first online class, or class 3. What we want to do today is a quick review of accounting. Maybe not too quick, we might take a little bit of a time here. It's very important to have a good understanding, foundational understanding of accounting before we get into financial analysis. Because if you're looking at ratios and looking at trends, but you don't understand what the underlying numbers are trying to tell you, it's going to be confusing and probably a little frustrating. So we'll review accounting. Hopefully you remember some of your accounting class. Haven't forgotten all of it. If you're an accounting major, obviously you'll have a lot easier time with it. As I tell my finance majors, they should understand accounting as well as the accounting majors because it's so central to what we do in finance. Once we finish the review of accounting, I want to introduce to you the template we are going to use for the first paper, your individual paper where you do financial analysis of a company. It's a template we're going to follow very closely. And once you see the template, we'll start on the first part of the template, which is the hardest part of the template by far. Students struggle the most with the first part of the template, which is liquidity. Once we get past liquidity, it does get much easier and much more straightforward. So that's good. We'll start with the hardest part, and then if you can tackle that, then it should feel like you've gained momentum and you're doing well with the rest of the template. So before we get into the class notes, I want to do a very high level review of accounting. So let's start with the balance sheet. Hopefully you remember the balance sheet. The left-hand side shows what the entity owns. We call those assets. Remember, an asset is anything that the accountants say have future value. We'll talk about some things that are assets that are not on the balance sheet, some things that are assets that we really question if they should be on the balance sheet. We'll get into some of those. But assets are what the accountants say a firm owns that has some future benefit to them. The right-hand side tells you who has a claim on those assets. It could be debt holders, other liabilities like employees. You might owe them salaries. You might have vendors. You might have accounts payable. They have a claim on your assets. If the firm goes under, those debt holders and other liability holders, they can come to the firm and say, hey, you haven't paid us. We want your assets. Once those groups have been satisfied, everything else belongs to the owners, to the stockholders. We call that net worth. And this is one of the confusing things about accounting and finance is we have a lot of terms for one thing. And net worth is one of those places where you'll hear the term net worth, you hear the term owner's equity, stockholders' equity, book value. There's many, many terms, and I have to be careful in this class because I will just randomly switch between those terms because they're so common to me through my career. And then the field I worked in, which was banking and insurance, we had a lot of other terms for net worth besides those terms. So if I use a term, you're not sure what I mean, stop me immediately or email me while you're watching the video and say, wow, you used this term and I don't know what that meant. Because I sometimes slip into the jargon of finance and accounting, and that's not a good thing to do because it just makes it confusing. I wish we were a little bit more clear in our terminology and didn't have so many terms for the same thing. Now, you should learn double entry bookkeeping, double entry accounting, pretty amazing things. You have debits and you have credits, and your debits always have to equal your credits. Just to remind you, on the left-hand side of the balance sheet, if you increase the left-hand side, that's a debit. If you reduce the left-hand side, that's a credit. On the right-hand side, if you increase the right-hand side, that's a credit. If you reduce the right-hand side, that's a debit. So let's talk something simple. Let's say you buy a car by issuing debt. So now you have a car, so the car costs, say, $15,000. So your assets go up $15,000, so you debit assets, an asset called car. Your liabilities go up $15,000 because you bought the car on credit, so you credit debt. So you debit cars, credit debt, and both sides of the balance sheet go up. Or you could buy the car with cash. If you do that, the asset car goes up, so you debit cars for $15,000, but then you credit cash. You reduce an asset, you credit cash for $15,000. Your balance sheet, your assets don't increase. You replace cash with a car, but that was entirely on the left-hand side. So that's the debit and credit side. You don't have to do debits and credits in this class. We're going to look at the result of all of that. But I think it's always healthy to remember, maybe you did something called T accounts. I think T accounts is a good way to think about accounting. We won't do it much in this class, but I still think it's a great way. I've done some accounting for not-for-profits where I would build the entire ledger for the company using Excel and using T accounts. I like the T account approach, but it's just debits and credits. Every time you debit something, you must credit something. So you either increase and decrease the left-hand side, or you increase the left-hand side while you increase the right-hand side. This always has to stay in balance. Why? Because assets must always equal liabilities plus owner's equity. So the balance sheet reflects the entity's financial position at a given point in time, in 1 second in time. And so we use the words as of. So we'll say this balance sheet is as of December 31st for 1 second at 11:59:59 on December 31st. This is what the firm owns, and this is who has claims on them. 1 second later, the next day, 2 minutes later, 2 months later, the balance sheet will change. And it can change pretty dramatically. I remember at UTSA, just cash itself could swing $200–300 million within just a matter of a few seconds, a few minutes. And so the balance sheet can change quite dramatically because these are large firms doing huge transactions all day long, just many, many transactions throughout the day. And so the balance sheet is only a reflection for 1 second at one point in time. Not all firms will have as of December 31st. You'll see that when we do paper one, firms have different fiscal years. I worked in insurance and banking, and insurance and banking are almost always fiscal year is a calendar year because they're regulated entities. So they have to provide financials to regulators as of December 31st. But retail firms usually have their year end, maybe March or April, because they don't want to have a year end during the holiday shopping season. But for this particular example, I use as of December 31st. Here I did 2019. That's probably be 2020 now. The other financial statements are period financial statements. We don't use as of for the other statements, like the income statement's probably the one you're most familiar with. We don't say as of December 31st for income statement. We say for the period ending. So the other financial statements are showing what happened over a particular given time, usually for 1 year. That's what we'll be looking at for 1 year. And essentially what they're telling you is how did you get from one balance sheet to the next balance sheet? What changed? Now, we are going to use generally accepted accounting principles. You've probably heard this as GAAP. So we're going to use GAAP. That's a US based. There are other approaches. I worked in insurance and they had statutory accounting in addition to GAAP. There are tax-based financials for the IRS where you have a completely separate set of books for that. Sometimes management will have their own rules internally, how they look at the books. And then what's becoming really important, and you're somewhat at a kind of a awkward timing in your college because of what's happening with IFRS, or International Financial Reporting Standards. IFRS keeps threatening to take over the world, that all companies are going to move to IFRS. It seems to keep getting delayed. I don't know. I'm not an IFRS person. If you're an accounting major, you may have to come back and get a master's degree just to learn IFRS, or you'll definitely be reading up. What's the difference between IFRS and GAAP? What are the main controversial points? Obviously, GAAP is going to have a heavy influence on IFRS. There is a professor at UTSA. I can never remember her full name, but if you're an accounting major, let me know and I'll give you her name. And if you can take a class with her, I would definitely take it. Her first name's Cheryl, but I always forget how to pronounce her last name. But she worked for the SEC and was heavily involved in the IFRS development. And her knowledge and background is phenomenal. Plus, he's also a really excellent professor, really fun professor. So, you know, there's things that are changing. And so we're going to use GAAP, but it's possible in the future GAAP is going to look somewhat different as we move to these international standards, but we'll see. Right now we'll be using GAAP. And eventually IFRS will become GAAP. There won't be a difference between the two. US will follow it's whatever the global standards are. So let's look at some of these financials. So what we're going to do is say, how do we get from this balance sheet at year 0 to this balance sheet year 1? So there's 3 financial statements that get us from one to the other. So the first one is a statement of cash flows. We will use the statement of cash flows. Notice it's for the period ending. What it tells you is, how did cash change? Now, one thing I used to do in this class, but I don't anymore, but if you're an accounting major or a finance major, I would strongly recommend that you be able to do this, and that is be able to produce the statement of cash flows from a balance sheet and income statement. If all you have is a balance sheet and an income statement, you should be able to produce the statement of cash flows. And why is that? Well, because we know assets equal liabilities and net worth. We know this left side has to equal the right side. And so if you go from the change in cash, the change in cash from one period to the other must equal the change in everything else. Because cash went up $10,000, the change in everything else must have gone down $10,000. And so if cash went up, other assets must have gone down, or debit liabilities and net worth must have gone up. So you just watch everything that happens, and that's really, really important when we talk about accounts receivable and inventories and accounts payable. There's an extremely important concept there to understand how that affects the liquidity and working capital. We'll get into those, but it's an extremely important concept. So if you are an accounting major or a finance major, you should be able to produce a rudimentary statement of cash flows from a balance sheet and income statement. I encourage you to try it. If you try it and you can't get it to work, set up some time with me and I'll show you how to do it with some simple companies just online, maybe using Yahoo Finance. It's a really good skill to have. I don't do it in this class anymore just because there's other things I want to get to, and hopefully you've done it in your accounting class. If you're a finance major and you ever take the Chartered Financial Analyst exam, the CFA, part 1 of the exam often will have a question related to producing a statement of cash flow if all you have is a balance sheet and income statement. So it should be possible. But we are going to definitely look at this. There's 3 parts to the statement of cash flow that we'll talk about here a little bit later. Operations, cash from operations, financing, and investing. We'll get into those 3 pieces, and we'll definitely be using these 3 pieces when we do your paper 1, the financial analysis of your company. The second statement is the least used financial statement. It's the statement of owner's equity. It's also for the period ending. And what it does is it tells you how net worth changed from one period to the other. So it sounds really important because net income is the biggest part of that usually. However, we have another statement, the statement of net income, that we'll use much more heavily. And the reason these other things that change are not that important to us is that we can get that information from the statement of cash flows. So most of the information in the statement of owner's equity is somewhere else in much more detail. So in this class, we will actually never use a statement of owner's equity, not because it doesn't have any important information, but only because the information it has is contained elsewhere in more detail. And then the last statement, the most famous one, the one that's used the most, is the statement of income, the income statement. It's also for the period ending. It has 4 pieces to it: revenues, expenses, gains, and losses. And it's the same net income that you have in the statement of owner's equity. So it gives you more detail on that statement of owner's equity. So it doesn't really give you the change in the balance sheet. It just gives you the change in net worth, the biggest part of the change in net worth, in a lot of detail, because it's the most important thing we're looking for. How much profit has the firm produced? So that's what we're going to be working with, those 3 statements. There's 4 statements. We'll be using 3 of them. The balance sheet, which is an as of statement, the cash flow statement, the income statement. Those are for the period ending statements. We'll use those three statements, and the statement of owner's equity we will not use in our class. So now I want to jump over to the class notes. I'm on page 3 of the class notes. There are times I will add some information. I might type it into the notes. If I do that, I'll try to remember to not save that so that I don't mess up my page numbers, so you always know what page number I'm on. It's possible when I get to page 40, I'll be on page 40 and you'll be on page 39 of your notes, but you should be able to find it pretty close in your notes. So this is a quick review. We've already talked some of this stuff. So we'll get into the actual financial statements here in a little bit, but let's talk about accounting and what accounting says it is trying to accomplish. So accounting says they have some criteria. Their goal is to be useful for decision making. And so if they're going to be useful for decision making, the accountants say there's 3 things. This is coming from the accountants. This is not my opinion. This is coming from actual the actual rules of accounting for GAAP accounting, what you're trying to accomplish. And what the accountants say they want is relevance, number 1, reliability, number 2, and comparability and consistency. All right. So those 3 things. On relevance, they want the accounting information to be relevant in a few ways, in 3 ways. First, they want it to be predictive. And what that means is the financial statements we get today should help us forecast financial statements in the future. So they should be, at least you can look at trends. We won't be doing forecasting in this class, although we'll definitely talk about it. But what we'll do on paper 1 should definitely help set you up to do a forecast. And we'll talk through that, how you can see some firms are much easier to forecast than others. Like Costco is a very easy firm to forecast. A firm like Tesla is a very difficult firm to forecast. But the accountants want as much as possible to produce financial statements so you can do a good forecast into the future. The second thing we have related to relevant information is the feedback value, which is closely related to predictive value. What that means is you get a new set of financial statements and it either confirms or contradicts what you believe. It gives you feedback so you can make a change to your forecast. So you thought the margins were going to be declining. You get a new financial statement and margins actually improved, and you go, okay, wait, there's something wrong in my analysis. I need to fix this and come up with a better forecast. The third thing related to relevance is timeliness. And the accounting world has gotten really good at this because of technology and just how rapidly we can do things these days. Accounting information is far more timely now than it was, say, back in the 1930s. In the 1930s, you might have waited 4 or 5 months to get the financial statements for your company. Today, I remember at UTSA, we started at like +7, then +5, got down to +3. I don't know where they are today, but they would close the monthly books on +3 when I was there, and we were getting faster and faster. Google, I heard at one time that Google closes its books every day. They have financial statements every single day. That seems a little excessive to me. I don't know if that's possible in an insurance company because of the actuaries. I don't know if we have actuarial science majors in this class. I hope we do. They're a great resource for especially quantitative analysis. But they do a lot for the financials for insurance companies, which you cannot do in just a few minutes. It takes quite a bit of a statistical analysis to figure out how to set up a lot of the liabilities in an insurance company. Same thing with banks. Banks have to set up loss reserves, and it's hard to set those up in just a few minutes. You need to look at a lot of data. It's a lot of quantitative. But even with that, those industries that need a little more time, they're still closing their books, and probably it's getting down to +1 or 2 these days, pretty rapid. So relevance, we want information that helps us predict the future, and we need it timely so that it's not old information. But counteracting that is reliability. Reliability is we want stuff that is verifiable, that we can actually know that it's true or have some proof that it's true. We want it neutral. We don't want to have a bunch of biases. Obviously, there are biases in accounting. Management is going to somewhat skew the numbers to their benefit if they can. They can't do it too much, and hopefully the auditors will slow them down. But we want the information to represent what's really happening with the firm. You're going to see with your companies that there are places where accounting is really frustrating, either on the relevance or on the reliability. There's going to be some accounting practices that you'll think, wow, I wish they didn't do their accounting like that. There's places where I really don't like how accounting works. And then reliability, you're going to be wondering, I wonder if that's really true. Can I really trust it? One thing we'll definitely talk about is cost of goods sold and some of the issues with the reliability and relevance of that number. It's just a little frustrating. But that's it. Accountants, it's not a problem of effort and intelligence and just abilities. The problem is the complexity of the world and the complexity of these companies. Accounting is doing their best to try to put numbers down so you can assess the firm, realizing that what firms do is incredibly complex. There's a lot of things going on at once. There's definitely going to be some errors. There's going to be some questionable data, but the firms are putting together the best that they can. And when the auditors audit it, they're not auditing it to say that it's perfect. They're saying that it's good, it's acceptable, it's good enough for the purposes of what the finance community will use them for. But as much as we struggle with these, and I think accounting has gotten much better, especially on number 2, but has gotten better on number 1 as well, the one area of accounting that is the most frustrating is comparability and consistency. Comparability is that you can compare your company to other companies in the same industry. Consistency is that you can compare your company across time. And you're going to be so frustrated. Part of the reason I do paper 1 or project 1 the way I do it is so you can see how complex things really are. A lot of classes like to use these cleaned up case studies where everything's perfect and everything's put in place. Any of the bad stuff has been fixed. That's not the real world. Companies are complex. They all have something going on that's a little unusual. I want you to see those. The advantage in Project 1 is that there's times where you'll just have to say more research is needed because you're just not going to have the time to fully research every little blip in these financials. But comparability and consistency are tough. Now, I think accounting is getting better on some of these. I know the rules for accounting for leases, L-E-A-S-E-S, leases, is changing, and I think in a way that is far better. The accounting for pension plans, something I was heavily involved in my career, that accounting has changed. I still don't think it's quite where it needs to be, but it's definitely a lot better than it used to be. So there are things where I think comparability and consistency are getting better. I think there's also areas where they're getting worse. The accounting community seems to be so fixated on fair value accounting, and the finance world really doesn't care much for those rules. So there's a little bit of conflict here. The accountants say they want to mark everything to market, do everything on a market value basis. The finance community says that introduces far too much subjectivity to this. If you're a finance major, there are some generally accepted accounting standards, some FASBs, financial accounting standards, that you really should read, that are really quite controversial and really having a lot of impact on finance right now. And that gets back to the comparability. When you have these major accounting changes, it makes it hard to go back and look at a firm 10 years ago, 5 years ago, and have it mean anything to you because the accounting rules have changed so much. So you'll be struggling with some of these things, which is fine. That's part of, I realize that when I'm grading your Project 1, I understand that, and I actually want you to face those, not to get you frustrated with the process, but just so you get a sense of how much of a deep dive you need to do when you start working for a firm to truly understand it. So let's get into these statements. Let's start with the balance sheet. As I mentioned before, it's a financial position at a point in time, what the firm owns and who has claims on it. So the elements of the balance sheet are assets liabilities, and owner's equity. Within assets, we have current assets and non-current assets. Current assets, we're going to spend a lot of time talking about current assets, especially accounts receivable, inventories, and the prepaids. You may have heard in GAAP accounting the matching principle, that you want to try to match revenues and expenses to the same period when the revenue was earned. And because of that, we need accrual accounting. Hopefully you've heard that term, accrual accounting. What accrual accounting means is it's not just cash. We are not going to make entries just because there's a cash transaction. So accrual accounting says there's times where we'll make an entry where no cash has changed hands at all. So a good example is accounts receivable. You sell something to someone, but they don't pay you for it. They owe you money. So you debit accounts receivable, you credit revenue, and no cash changed hands. That's an accrual. That accounts receivable is accrual. And accrual is where we're going to have some of our issues, especially related to liquidity. So accrual accounting is really important here. So current assets, they're expected to be converted into cash within 1 year. Obviously, cash is already cash, so that's a current asset. You hope your accounts receivable will be converted into cash within 1 year, but not every firm is like that. If you think of Boeing may be selling several hundred planes to China, and they may not, their accounts receivable to China might be 10 years. China might pay 20% at this point, another 30% at this point, and then makes the final payment after the planes are delivered. So not every firm has current assets that will be converted within 1 year. So, I mean, the real rule of accounting is that it's converted within 1 year or within the operating cycle. So some firms have really long operating cycles. Inventories. So here's a case where you buy inventory, maybe you buy it on credit, but you have inventory. Inventory goes up, but you haven't sold it yet. So you have to leave it on your balance sheet until you sell the inventory. And it just sits there. Once you sell the inventory, it moves from inventories to cost of goods sold. Hopefully you remember that, but we'll get into that a little bit. Prepaid expenses. If you live in an apartment, you have a prepaid expense. My guess is your apartment requires you to pay your rent the last day of the previous month. So you pay your rent before you've consumed the apartment living. So that's an asset to you. You paid your rent. You now have 30 days to live in this place. That's an asset. To the apartment complex, it is an unearned revenue. We may talk a little bit about unearned revenue. Some of the firms you're going to do, that's a big thing. That's when you get your revenue before you earn it, and that becomes a liability. So we'll look at that under liabilities. It's just the mirror of the prepaid expense. So we will talk a lot about these three items and some others. Then you have non-current assets. You have just longer-term investments. That's not a big deal for most of you, although firms like Apple and Google do have a lot of that just because they're holding a couple of $100 billion in cash, and rather than just having it sit in cash, they went out and bought longer-term securities. But for most companies, that's not a big deal. Now, in the area where I worked, which was life insurance and property casualty insurance, their longer-term instruments is the biggest asset on their balance sheet because of the nature of their business. That's just what they do. But for most of your firms, that won't be an issue. For most of your firms, it's going to be property, plant, and equipment. So property, plant, and equipment, for those assets, we are going to use net book value. We do not use market value. And net book value is simply how much we paid for it minus what we call accumulated depreciation. We're just going to expense that asset over time. It's a very random, non-economic event, but for our purposes, we are going to just use the numbers that they are on the book. You know, I worked at USAA. USAA has a huge office building, and now they're moving all over to the city. It's amazing how fast they're growing their employee base. But they have that huge office building. I forget how many, 4 million square feet or whatever that thing is. It's on their books for what they paid for it minus depreciation. What's the true market value of that building? Who knows? Because who could actually buy it and move into it? It would be a really difficult sell to make. So it's probably worth a lot more than what is on their books, but we really don't know. No one really knows what that building is worth. Um, so we're just going to take the value as it's on the books. We're not going to try to adjust it for fair value accounting. The other thing you'll see on your balance sheets is intangible assets. We're going for the most part, we're going to ignore these for our class. But they're pretty important. For some of your firms, goodwill is a huge asset on your balance sheet. You might look and just see. Goodwill is a really unusual thing. It's when a firm buys another firm, but they buy for more than what the book value, what the accountants say that firm is worth. Remember, book value, that's the net worth of the firm. So if you buy another firm and the accountants have it have its net worth as $100 million, but you buy for $150 million, that $50 million has to go somewhere. And the accountants say, hey, just plug it into assets and call it goodwill. We'll create goodwill of $50 million. It's not a number finance really trusts very much, but it's a number we're somewhat stuck with just to keep the balance sheet balanced. So we won't spend much time with it. The other ones, patents, trademarks, tend to be really small numbers. So those are at amortized costs, which amortization is a lot like depreciation. We're just going to take that 50 million in goodwill, and we're just going to reduce it over time to zero over, who knows, 10, 20, 30 years. Now, as I mentioned earlier, there are assets that a firm has that are not on their books anywhere. So brand identity is an important asset of a lot of firms. In fact, there are some great websites. You should probably go out there and actually Google them. I like to, throughout the class, give you things you can go out and do an internet search on. And this is one of those. If you go out and do an internet search on brand value, there are 3 or 4 websites that actually try to value the brands of companies. They show the most valuable brands are brands like Alphabet or Google, Facebook, Coca-Cola. And how do they value these brands? Well, they essentially look at a firm like Coca-Cola and they ask the question, how much more can Coca-Cola charge for its product? How much more kind of markup or gross margin do they get versus a firm that doesn't have their brand identity? And that value of that brand identity is just the value today of all that future extra income they make because of the brand that they have. It's a really subjective number. So if you look at 2 or 3 different websites, you'll find their value of brand to be radically different one company versus another, but they're very interesting companies. Employee training, well, just employees, period. You know, if I look at a firm like a consulting firm, like Accenture. Accenture is a big, well-known, very high-quality consulting firm. Their most important asset is their employees. And yet their employees are expense. They're not anywhere on their balance sheet. And even training those employees. So you spend $50,000 training a few of your employees that give them much better skills. That should have a future value for years. And yet the accountants say, no, we don't know how to value what that future value is. Just expense it all this year. Research and development, I know there's a lot of accounting rules on that. We'll talk some about that when we get into Project 1. But for a lot of firms, their research and development costs must be expensed. They cannot put them on the balance sheet. Some firms, they are allowed to put that research and development on the book. So it depends on the firm and on the accounting rules. So some assets have questionable value like we talked about, goodwill. Some assets are just an approximation, like we talked about property, plant, and equipment, patents, and trademarks. They're just random numbers. Even the accountants admit that net book value is not an economic number. It's just a number we need to keep the books working. Then we jump into liabilities. Again, we have current liabilities and non-current liabilities. And we're going to talk a lot about these current liabilities, accounts payable, trade payables. That's when you buy something on credit and you have to pay them later. Debt, obviously you borrow money. And then your other accrued expenses. So a good example, like UTSA, they would pay me every 2 weeks, but I would work the first 2 weeks of January and they'd pay me on the third week of January. So what that meant at the end of the second week of January, they owed me 2 weeks of salary, but they're not going to pay me for another week. So they have debt to me of 2 weeks of salary, and they won't pay me for another week. So that's accrued expenses. So it's a really cheap way to borrow money because you don't pay interest on that kind of debt. Then you have your non-current liabilities, obviously your long-term debt, your leases. That's the part of accounting rules that are changing. You have your benefit plans, your pension plans, those type of things. Things like 401k plans, which many of y'all might get in your first job. Those are generally not on the balance sheet of a company because those assets don't belong to the company. They belong to the employees. So we talk about those being off balance sheet. And that's perfectly fine to be off balance sheet. That term's gotten some bad press after Enron, but off balance sheet is fine. You don't really want the 401k plan showing up as assets and liabilities on your company's books because they're not the company's money. It belongs to the employees. They're separated off as a separate entity. Deferred taxes, a part of accounting I really hate because it's just so, I think, unnecessarily complicated. We are going to just somewhat ignore deferred taxes, but a few of your firms are going to have some blips because of deferred taxes. There was a major tax law change back in 2017, and that had a huge impact on deferred taxes, and it caused some firms to actually show a huge loss. You would think they reduced the corporate income tax that would be beneficial, but for deferred taxes, it's actually harm deferred taxes. Because of the way, we won't get into it, but it's quite complex. So for our purposes, we're just going to accept that it's there, assume it's a good number, and not get into the intricacies of how that number is calculated. But if you're an accounting major, you're going to have to learn that. It's an important part of the accounting function. Some obligations are simply estimates. We just make our best guesses. Warranty costs, benefit plans, pension plans, health insurance plans. Warranty costs, if Ford sells a bunch of cars and now they got to do a recall on that, they don't just set that liability up the year they do the recall. They have to estimate how many recalls they might have in the future, how many warranty costs, how many, these cars are under warranty for a certain amount of time. They have to set up a liability even before they know the car is broken. So they're just estimates. As I mentioned, I worked in insurance. Insurance has huge liabilities that are entirely estimates by the actuaries. They even have something called IBNR, which is incurred but not reported. And what that is, they have to set up a liability for someone. Let's say one liability insurance companies have is for workers' comp for employees that have been exposed to asbestos, and so they're going to get cancer. Well, the actuaries have to set up a liability for the people who will get cancer who do not yet know they have cancer. So at the point in time they've been exposed to asbestos, that's when the liability is created, not when the employee actually gets diagnosed with cancer. And so the actuaries have to sit down and figure out what kind of liability we set up, even though the person that we're setting the liability up for doesn't even know that they have a claim yet. So, a lot of estimations, a lot of really cool stuff, I think, actually is pretty interesting stuff. There are some liabilities that we don't put on the balance sheet at all. GAAP says they either have to have at least a 50% chance of occurring and they must be quantifiable. If either one of those is not true, if it's less than a 50% chance or there's more than a 50% chance but there's no way to quantify it, in those cases, you might put it in the footnotes, but you will not record it as a liability. And this is why the footnotes can be so critically important to your company. I'm not going to ask you to get into the footnotes for your company, but you certainly could. I would definitely give you bonus points if you got into one issue in a little more depth. But take a tobacco company. They're getting sued. Back several years ago, before we knew the results of these lawsuits, they're getting sued for tens, if not hundreds of millions of dollars. They've got to sit down and say, what's our chance of losing? And if we lose, how much will we lose? If they don't put up that as a liability, they still have to put a footnote. But the lawyers hate that. GAAP accounting requires them to disclose this information, but that's like giving away information to the plaintiff lawyers. Obviously, if they say, well, the chances are more than 50% chance, then wow, the plaintiff lawyer is going to say, hey, see, they are admitting they're guilty. Or if they give a quantity, we think we'll lose 300 million. The plaintiff lawyer has that information. So there's sometimes accounting can really provide information firms don't want to release, and obviously they're going to try to hide that as best as they can so they don't give that information away. And there are offshoot obligations. Enron, that's, if you've heard of Enron and Enron's story, they went insolvent back in 2001, 2002, and they had a lot of off-balance sheet obligations. There are some off-balance sheet obligations that should make you nervous. Essentially, the firm's trying to hide stuff, but a lot of them are definitely not an issue. I worked at USA. USA had several special purpose entities. There was no cooking the books or playing with the books at all. It made more sense. They were really not USA's concerns, not USA's liabilities. So USA set them up separately. And the last part of the balance sheet is owner's equity. You have your contributed capital, retained earnings, and there's a lot of other things in here that we won't really get into too much. Also known as the book value. Again, several terms here. Some call it the net book value. So it's assets minus liabilities. So the book value of the firm. All right, so there's the balance sheet. Hopefully you feel comfortable with that. If not, we're going to hit on it when we get into project 1. So we'll see it again. We'll have some repeat of some of these issues. All right, let's get into the flow financial statements. Start with the income statement. Real quickly, 4 pieces: revenues, expenses, gains, and losses. Revenue and expenses, we refer to that as above the line. We refer those as normal operations, what the firm normally does. And the below the lines are these unusual things. So example might be Ford sells a truck. Well, that would be a revenue. Or AT&T sells one of these utility trucks. Well, AT&T is not in the business of selling trucks. So that would be a gain or loss. It's an unusual item. I'm not sure they do it like that, but you could argue that's a below the line because that's not their business. They're not in the business of selling trucks. So if they sell off a used utility truck, there's a good chance that would go below the line. And what we're trying to do with this above the line and below the line is to help investors understand what is a normal operation versus what's abnormal. Remember, our goal is to help the finance community forecast the firm. Well, if there's stuff in revenues and expenses that are a one-time thing and they're very material, we can help out the finance community by moving those below the line. Now, above the line and below the line, there's the GAAP version of it, which is very strict. But then there's what management actually reports. And management and other firms will actually move much more stuff below the line than GAAP accounting allows. So they call it pro forma financials, where they say we take all the unusual stuff out, put it below the line. GAAP does not allow you to do that very much. It's very strict rules. So does management play with this above the line, below the line? Probably so, because most of the stuff they moved below the line are losses. Well over 90% of the stuff they say, hey, this is not normal. This is a one-time thing. Over 90% of that is negative stuff. You would think if there's unusual items, they'd be just as likely to be positive as negative, but most of the stuff management puts below the line are negative things. Another thing you'll see management do is income smoothing. Management of firms know that stockholders really like nice, smooth, predictable earnings. And so what management will do is using accruals, they'll try to, if they're having a really good year, they'll use the accruals to move some future expenses into this year so that net income's not so high. So if their net income jumped 20% this year, they might move some expenses from next year into this year, so income only jumps maybe 12%. And that way they can increase next year's net income so that they don't have that 20% jump and then they drop 10%. Instead, they'll maybe jump 12%, and next year they'll artificially jump 8% because they smooth out the income. You cannot do that. That's not allowed, but managements probably do that. I remember I was on the board of a credit union, and we were having a great year, and there's an accounting change that we needed to take. And the first thing the board members asked for was, well, how good of a year are we having? And I'm thinking, oh, I don't want to hear this. Hear no evil, speak no evil. You definitely don't want to put something like that into an email. GAAP accounting should be based on what best reflects the financials of the firm. You do not want to make a decision based on income smoothing. So if you're having a bad year, you try to move some current expenses to future years. The contrary to income smoothing is the big bad theory. The big bad theory says, hey, we're having a horrible year. Let's take everything we can think of and move it to this year, especially if you have a new CEO. The new CEO, she comes in and says, you know what, we're having such a bad year. If you can load up our expenses this year so that next year looks great, then I'll look like a hero. I've turned the company around. And so big bad theory usually only happens in years like 2020, where you're having firms that are just being decimated with 80% drops in revenue. So 2020 was just a horrible year for airlines and cruise lines. There were probably some conversations saying, you know what, anything you can find, we can move into this year that's bad, move it in this year. So next year looks like a good recovery year. So Enron was a big story of bad accounting. So the question is, can we trust accounting now after Enron? And what I would say after Enron is accounting is probably more trustworthy now. There's many changes made. I think for a little while there was a lot of skepticism of accounting. I think the world's getting more comfortable with accounting and more trustworthy of it. 2008 was a debacle, but I don't think 2008 was an accounting debacle. I think 2008 was a recession. It was bad accounting, not because the accounting was bad, but because firms had really bad financial results. So I don't think 2008 was a debacle, except for banking. Banking definitely, and somewhat insurance. The fair value accounting, I think, really made the 2008 crisis far worse for banks. And I think the accounting world somewhat regretted the accounting they did in some of those banks. So if you're an accounting major or a finance major, there is a book I do recommend. I think it's really, really quite exceptional. So it's a book by a guy named Howard. It's called Financial Shenanigans. It's a really, really great book. I wish I could jump into the index. Maybe this one will let me get into the index. There we go. So he's got updated. He's got a 4th edition. I don't know any classes that use this book, but I think it would not be a bad idea to have an accounting elective based entirely on this book. So what he does is he gives some history of what's going on, and then he gets into the shenanigans. So how can management manipulate the books? One thing they can do is record revenue too soon, and he gives some examples of that. They can record bogus revenue. He gives some really quite amazing stories on that one. You can, what we just talked about, boosting net income with some one-time unsustainable activities and not moving them below the line. Trying to tell the stockholders, yeah, that's normal. We did well this year. Shifting current expenses to later periods. We just talked about that, income smoothing. Other techniques to hide expenses or losses. Shifting current income to later period, again, income smoothing. Shifting expenses to current period, income smoothing. You can see how income smoothing is a big one. Shifting financing cash flows to operating section, trying to manipulate the cash flow statement. So you can just see what they do. What he does in this book, which I really recommend it for finance majors as well, is he tells you how do you find these shenanigans. And his main point is with whenever management manipulates something on the income statement, they'll have to manipulate something on the balance sheet and the cash flow statement. And so you may not notice the shenanigan on the income statement, but something will stand out on the balance sheet and on the cash flow statement. And so he says there's ways, if you look at all the 3 statements together, there's ways to find that something has gone out of whack. I'm going to do a little bit of the financial shenanigans test on project 1. There's one chart I use. It's very simple. I just want to expose you to the concept of, can we trust these numbers? Most of you are going to say there's no problem, everything looks fine, because I'm giving you companies that are really well-run firms and tend not to have shady accounting. But just to give you an idea of how you can assess this issue. But it's a really, really good book. would be a great class. So some of y'all talk to Dr. Sanders or someone and say, look how inexpensive this book is too. The second you make this book a book for a class, its price is going to jump up to $300, unfortunately. But really good book, well written, well researched, a lot of good examples. So a book I would highly, highly recommend. All right, so statement of owner's equity, just not much there. The elements are net income, contributed capital, dividends and other distributions to owners, buying your stock back. We'll get into some of these, but we'll look at them in the cash flow statement and in other changes. So essentially, it's, you're just looking at how owner's equity changed from one period to the other. But again, we're not going to use this statement. So let's get to the next one. This one will have to go on to the next class. I told you we're going to start the template today, but I forgot how much time I like to use on the statement of cash flow. So it might be next class before we get into this. So the statement of cash flows, let me show you the template just real quickly, just so you see where we're going, and then we'll come back to the statement of cash flows. So here's the template we are going to use, so just you know where we're going. So when you do your project 1, we're going to assess short-term viability, make sure the firm's liquidity is fine, that their solvency is fine. Once you assess that, then we're going to look at the long term. We're going to look at activity ratios, margins, and profitability ratios. Activity ratios are related to top line growth, which is revenue focused. Margin is related to margins, which is bottom line focused. And in profitability, we're looking at return on equity and some other things. And the last thing we're going to do is look at relative value. And with relative value, what we're looking for here is, given all this assessment we've done, is this company's stock trading rich or trading cheap? And so we'll look into that. So when we get into the cash flow statement, we're going to spend a lot of time on liquidity, but you're also going to see a link to activity ratios. So this is why I say this is the hardest part of this template, is making this link between liquidity and activity ratios, or turnover. We use the word turnover. So as I start talking about, we'll come back to this template, don't worry, we're going to get into it in quite a bit of detail. But as I'm talking about the statement of cash flows, I want you to be aware that there's a link between the liquidity and turnover. And you're going to see as we get into this statement, we're going to bring up this term right now, talking about working capital. And it's an extremely complicated term. A lot of students really struggle with it. So we'll spend a little extra time. I really want you to understand it. One of the reasons it's so difficult is that how it's taught in the accounting class is so different than how it's taught in finance. There's things they use in accounting like current ratios, quick ratios, that we do not use in finance at all, except for in rare cases where finance is run by accountants. But when finance does not use some of these ratios, and I'm going to explain that to you. So I'm just setting you up for the hardest part of the next few weeks is this one issue related to the working capital accounts of a company. The working capital accounts are things like accounts receivable, inventory, accounts payable. And so we're going to have to handle that. So I want you to be thinking that template and understanding that we view this very differently in finance. So I'm going to get started on the statement of cash flows, but then come back to this next class and get into it in more details. So the statement of cash flows has 3 components: cash from operations, cash for financing, and cash for investing. We will definitely be using the cash from operations quite a bit, and we will be spending a lot of time on working capital. The 2 biggest differences between net income and cash from operations are working capital and depreciation. So we'll get into those. Now, your firm, is a good chance your firm is going to have some big difference between net income and CFO that is not one of these 2 things. And we'll talk about how do you handle that. Do you need to do more research, or you just say that more research is needed and you move on? I'm hoping a few of you will be curious enough that we'll actually go in and I'll work with you to go in and actually try to resolve that mystery. What else is going on? I've seen some firms where they'll do a special pension funding They'll fund their pension plan, and that'll be $100 million funding, and that'll cause a big difference between net income and cash from operations that's not in one of these accounts. So usually you can find it. It's not that difficult to find. It can take you maybe 30 minutes, 45 minutes, going through their annual report and finding it. I'm going to ask you to do those things, but I'm hoping some of you will be so pumped about accounting and finance that you just can't sleep until you answer that question. That's the way I am. Every time I see stuff like that, I'm like, okay, I got to go figure out what's going on here. So that's the cost of cash from operations. It's going to create some issues that you're going to have to try to resolve, or at least acknowledge that there's something that'll resolve. The financing activity are what you do with the owners and lenders of the firm. So you borrow money, you issue stock. That's a financing activity with one exception. There's one thing the accountants get wrong, and I wish they would fix it, is that interest expense is under cash from operations. And interest expense should be under financing activities. And not only do I wish they would change it, but all of finance wishes they would change it. If you take, again, the CFA exam, the Chartered Financial Analyst exam, part 1 of that exam is where they cover the accounting. And that's one of the accounting things they say you always want to change. Move interest expense, add it back to CFO, and subtract it out of financing activities. I don't know why GAAP accounting hasn't fixed that after all these years. But that's what financing activities are. We are definitely going to look at that. In fact, many of your firms are going to see that there's a lot of activity going on, especially the last few years. A lot of firms have been buying a lot of their stock back, and that's a financing activity. And then the last part of cash from operations is the investing activity. And this is when the firm buys something, like buys a new building, buys another firm, invests in long-term financial assets. We're going to get into this when we talk about capital expenditures, or CapEx. We want to look and see, what is the firm doing? Are they reinvesting in the firm and buying capital assets, or are they just sending all the money back to their stockholders? So one exception on the investing activity is the interest and dividends for those longer-term financial assets. They go through cash from operations. They don't go through investing. That's not a big deal for most of your firms. If you were doing an insurance company, that would be an important distinction. And their accounting is just wild. So yeah, the accounting for insurance companies, I was pretty shocked when I got my first accounting job in a life insurance company, how different it was from what I learned undergraduate. All right, so we'll start right here in our next class. And there is something I'm going to want you to read in advance. There's a blog I have on a term called free cash flow. I'll send that out in our weekly discussions. So I do want you to read this blog. And it's an important concept, free cash flow, and we'll get into that definitely in our next class.